In this video, we examine the outlook for the Philippine economy in the second half of 2025, covering topics from the US-Philippine trade deal to growth drivers and monetary policy directions. On 22nd July, the US and the Philippines concluded a bilateral trade deal with the revised US tariff rate at 19%, higher than the 17% announced in April, but lower than the 20% announced earlier in the month. In return, the Philippine government agreed to remove tariffs on selected US goods, with details of the deal remain subject to further negotiations. Still, a higher effective tariff rate would weigh on the Philippines' export prospects into the US. Nevertheless, the 19% rate remains comparable to those of regional peers, Indonesia and Vietnam, which negotiated reciprocal tariffs of 19% and 20% respectively. Importantly, attention will now shift to sector-specific tariffs, which could be more impactful since the Philippines' exports to the US are heavily weighted towards semiconductors. Back home, the pivotal midterm elections concluded in May, with the opposition delivering a strong performance in the contest for 12 Senate seats. In response to the surprise gains, President Marcos Jr. issued a directive requesting courtesy resignations from all key positions. Importantly, he has retained his core economic team, implying policy continuity for economic and fiscal policies. We expect the Philippines economy to grow 5.5% in 2025, down from 5.7% in 2024. Nevertheless, the path ahead remains stable, and we expect better GDP growth momentum of 5.6% year-on-year in 2Q to 4Q 2025 compared to 5.4% in 1Q 2025. In the government's latest growth targets, the official GDP growth target for 2025 has been revised lower to 5.5 to 6.5% from the previous 6 to 8% range. Meanwhile, the growth targets for 2026 to 2028 have been narrowed to 6 to 7% from the previous 6 to 8%. Nonetheless, the Philippine economy remains one of the fastest growing economies in the region. The lower than expected 1Q 25 GDP print belies signs of resilience in domestic demand, with the contribution of domestic final demand higher at 7.9 percentage points in 1Q 25 from 5.8 percentage points in 4Q 24. Corroborating the stronger domestic demand picture, imports of goods and services were up by 9.9% year-on-year in 1Q 25 from 2.7% in 4Q 24. Goods export growth picked up to 6.2% year-on-year versus 3.2% in 4Q 24, mainly due to front-loading of some electronics exports to the US, but services export growth slowed. As a result, the negative contribution of net exports widened in 1Q 25. We see better domestic demand in the coming quarters. Private consumption spending is projected to remain robust, underpinned by strong labour market conditions, low and stable inflation, and looser monetary policy settings. Looser monetary policy settings will also benefit investment spending as the monetary transmission mechanism takes effect in the real economy. However, private sector investment spending will likely remain on the sidelines during this current period of external uncertainties. We expect the public sector capex to remain supportive of growth under the government's flagship Build Better More program. These will more than offset the weakness in government consumption expenditures as spending normalizes following the midterm elections. This will also be supportive of continued fiscal consolidation efforts. In the government's latest medium-term fiscal targets, the FY 2025 to 28 deficit has been recalibrated and pegged at 4.3% of GDP in 2028 versus 3.7% of GDP previously. BSP has stepped in with two 25 basis points rate cuts this year, most recently in June, bringing the policy rate down to 5.25%. We believe the case for further easing remains intact as lower inflationary pressures will allow the BSP to continue its monetary policy easing cycle path. Headline inflation in the Philippines has largely been subdued, averaging 1.8% for the first half of the year, sitting at the lower end of BSP's 2 to 4% target range. This was largely driven by lower food and energy prices. To that end, we see room for BSP to cut its policy rate by a cumulative 25 basis points in rate cuts for the rest of 2025, taking the policy rate to 5% by end 2025. The balance of risk is skewed towards more rather than fewer cuts given the downside risks to growth stemming from global factors.